Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 5570 as I'm talking. That is up about 17.5% year to date. 10-year Treasury, just for reference, right at about 4.25 percentage points, which is up a little bit since the beginning of the year, but down a little bit off most recent highs. So right there in that kind of 4.25% range that we've been trending at for the past couple of months. All of this driven a little bit by a weaker jobs report on Friday of last week. So for those of you who missed it over the July 4th sort of vacation week, on Friday, we got jobs numbers, and the unemployment rate was, everything in that report actually was a little bit weaker than I think people anticipated. Unemployment rate ticked up to about 4.1%. We continued to see declines in the overall number of job openings that are out there, continue to see gradual, modest declines in what's known as the quit rate, which is the number of people that are actually actively leaving their jobs. And just a lower jobs number added to the economy over the past 2 months. Really, everything in that report was probably a little bit weaker than what people anticipated, kind of continuing that trend. And I would note this is the first time this cycle that the unemployment rate has kind of ticked up above 4.1%. And this is definitely continuing that narrative of, kind of bad news is good news, right? So all eyes being on the Fed after the beginning of the year and the kind of stronger than anticipated inflation numbers. Really anything that points to sort of a continued kind of weakening, softening economy that will then result in kind of lower CPI, lower inflation numbers going forward, really being welcomed by the market that, once again, I think is looking for that initial rate cut in September, looking at the Fed to say, yep, we are done with this rate hiking cycle. And so I think in that respects, everything that we got out of that jobs number is good. There are two caveats that I would note. The first is, hopefully, we see those weaker, sort of modest, weakening, softening jobs numbers actually show up in the inflation data. So the last print that we had on inflation was weaker, and that was certainly welcomed by the market. I would note that most of the jobs data that we are seeing in that most recent report is actually a continuation of a softening job market over the first half of the year. And certainly in the first half of the year, we saw strong inflation data, despite the fact that we had a weak jobs market. So hopefully, weaker jobs market takes a little bit of pressure off that inflationary number. We see that inflationary number comes down, and that doesn't give the Fed the sort of impetus to cut. I do think that a weaker unemployment number or a weaker jobs number does give the Fed less inclination to actually raise rates if they don't get the inflation numbers that they're seeing. But that's neither here nor there. Hopefully, first caveat, we see these weaker numbers kind of showing up in inflation. We continue to see inflation cooling. Second caveat that I would put out there with respect to these numbers is, a little bit like my mother's cooking, too much can be a bad thing. So right now we're in the bad news is good news because we want to see the economy cool. Just remind everybody that we don't want to see too much bad news because if we see too much bad news, then we might start to flip to the narrative of, oh my goodness, the economy might be cooling a little bit too rapidly. Maybe unemployment is going up too fast. Maybe we might be headed for that dreaded recession or R word. That narrative has been absent from the marketplace for quite some time. However, I would note that it is the logical narrative for the market to pivot to if the economic data becomes too weak. So right now we're right in that sort of center Goldilocks vibe of weak but still pretty good. We kind of want to stay there if we can because on either side of too strong or too weak is a place that the market doesn't generally like. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.